And now we are going to continue with the presentation of that is going to be carried out that is going to be carried out by Maria Zhang. She was already presented yesterday, but just in case, she's a third-year PhD candidate in the Accounting Information Systems at Rutgers University and holds a bachelor degree in Finance and Economics. Her research interests include firm comparability, cybersecurity, and consumer privacy issues. And she's passionate about spreading the impact of the findings in the academic world to practitioners and to students. So the floor is yours.
Thank you so much for the kind introduction. And thank you, Marco, for the very technical presentation. I definitely have more questions for you, but I'll follow up on that. And I apologize at the beginning that I don't tell jokes, so it's not going to be as funny as Professor Hussein's presentation. But I might take a 3-credit course of stand-up comedy from you, and I'll improve this. Oh, as much. I'm so sorry. Yeah, I apologize for that. Yeah, but so today my presentation is going to be a very different topic than the presentation I gave yesterday, which is consumer privacy issues. So today I'm actually going to talk about the same topic as Marco just talked about, the financial statement fraud detection. So what we want to do in this paper is kind of twofold. Well, firstly, I think I should address the issue of the title, so misstatement detection based on virtual pure players. I'm a little questionable about this title myself because it's not very straightforward, and you don't really know what virtual pure players are just based on this title. So actually, the idea is very simple here. We just put a very new word here, but the idea actually is very simple. So what we want to do is to actually look at the granular segment reporting information of the public companies in the US and try to see how decision useful it is for the investors. Because basically, recently there is a big discussion from the FASB that they want to rethink how they regulate how public companies report their business segments. And basically, I think from what I heard in their meetings, they are leaning towards giving the management more discretion on how they report their business segments. And that would evidently kind of decrease the comparabilities among different public companies if the management have more discretion on how they disclose their business segment information. So this is why we started this project. We want to see how these segment level information are comparable among firms and how informative they are in terms of financial fraud detection. And also another idea is from Professor Miklos, because he's always telling us, conglomerates are basically clouding their true financial status and information from investors because they're so big and they're operating in so many different industries, and it's very hard for us to tell how exactly they're doing in their different business segments and how they're doing in their overall financial status. So this is why we started this project. We want to have some policy implications from our findings, and also we want to bridge the gap between the prior literatures about the comparability and informativeness of the business segment reporting. Okay, so I'm just gonna start the presentation slides. So first, we have a little background introduction on the U.S. Again, this is in the U.S. context. So the U.S. Segment reporting guidance basically started very early in the 1976, as you can see on the slide here. And from the beginning, it's always been a management approach on giving management the discretion of how they report their business segments. So this is how they make this decision about disclosing business segments is basically they have these chief officer of decision making, and this person essentially decides what business segment information is used internally, and how he felt it would be useful for the investors to know about these information. And these actually, from prior literature and from the for example, the CFA Institute, we can see quite a contrasting results or findings as of whether this management approach of business segment reporting would increase the comparability or information usefulness to the investors, or it will decrease and cloud investors' judgment. So this is why we kind of want to provide the empirical evidence in our paper, and to show that from the the U.S. Public companies business segment level financial information, whether it will be useful for the financial fraud detection. Okay, so I already talked about the contribution, and again, I want to address the title here. The virtual pure players is basically how we call it, how we call our process of breaking down the conglomerates into their reported business segments, and we use the reported business segments SIC code to kind of use this thing as the we call it as the virtual pure player. So each conglomerate would have several virtual pure players within them. This is how we define this term in our paper. And here's some summary statistics from, but we got our data from CompuStat, and this is some summary statistics we found before we started the actual statistical testing. So as you can see on this slide here, on the upper part, we have the summary statistics of how many companies are reporting business segments over the years, and we also have how many of these companies. How many companies are single players, as in they don't have multiple reported business segments. And we can actually see that the number of companies reporting business segments are around the level of 8,000 companies. And the companies that are not, so the second figure is the companies that are not single players, so which means they have multiple business reported business segments. So that's around the level of from like 1,500 to 2,000. And actually, we also found that so over the years, the public companies in the U.S. are remain about the same level, only decreased a little bit, but the market capitalization of these companies are increasing, but the number of segments that are reporting are decreasing, which means the segments are getting bigger and bigger. So it's kind of hard for us investors to get some useful information from the business segment reporting. And for the second part of the summary statistics, we have the number of companies reporting 10K each year, and the number of companies receiving AER, which is the proxy we use in this paper for financial fraud. So the companies reporting 10K each year is basically the number of public companies in the US. And we can see that they remain in about the same level, only decreasing a little bit in recent years. And the AER remained about the same level, but has a peak around the 2000 tech bubbles events. So this is the summary statistics that we want to show you. And for the next slide, we have the Libby box, which here we want to introduce to you the basically the proxies we want to use for us to test the hypothesis that we have here. So for the independent variable that we want to use here, because we want to see the informativeness and comparability of segment information, here we want to use here we want to define our independent variable as the segment reporting quality, as well as the actual segment level financial information. So I will discuss this later in later slides in more detail. The exact variables that we constructed to measure the segment reporting quality and segment level financial information. For the dependent variable, I already talked about in the prior slides, the AER enforcement release is the proxy for our financial fraud in this case. Okay, so as I said, I'm going to talk about the dimensions for us to measure the segment reporting quality and segment level financial information in detail in this slide. So first of all, how we measure segment quality is actually we constructed 3 separate variables. So they are listed here on this slide. The first variable we constructed to measure segment reporting quality is the average number of missing values of the segment raw financial information. So because when we looked at the CompuStat public companies financial business segment reporting, the first thing we noticed that is a lot of companies are having missing values for their reported business segments. So mainly from the data we see that sales is an example of most business segment reports would have this sales data, but for these other variables, for example, financial variables, for example, the development. I don't know if I have the summary statistics here. Right. So for example, for the development and innovation, maybe that is something that business segments do not report for most firms. So we kind of want to use this severity of missing information from reported segments to proxy for at least for one part of the segment reporting quality. And the second variable we constructed here is the change of reportable segments. So we measure the over the years whether the firms, whether the conglomerates, the multi-segment firms would change the number of business segments that they report. So this is the second variable that we constructed here. And the third variable we constructed here is the allocation of expenses and costs to a specific business segment that's called corporate or other. So this specific business segment called corporate or other is kind of a vague, has a kind of a vague definition, so it doesn't have any actual business operation to it. So it is very from prior literature. So they examine how companies sometimes would allocate their allocate some of the expenses and costs to this corporate and other segments from their main business segments to kind of show that, to kind of manipulate the investor's perception of their main business segment's profitability. So this is why we constructed this third variable here to measure the segment reporting quality. And for segment level financial information, we also use both the raw financial variables at the segment level and also the financial ratios. And we Winsorized and calculated the standard deviation from segment industry peer average. And what do I mean by that? I already explained the pure player construct in our paper, which is we break down these conglomerates based on the reported business segments, and we use they each have their individual SIC code. So we use this construct to have a segment level pure virtual pure player level industry based on the SIC code. And we see for each firm, each of their reported business segments, among all the business segments of the same SIC code, where does it stand? Does it stand close to other business segments of the same SIC code, or is a big deviation? So basically, this is why we calculated the standard, we Winsorized and then calculated the standard deviation here, because we want to see whether it deviates from its segment level peers. And then because this segment level financial information would be at the segment level, right? It's self-disciplinary. So we have to merge the dimension 1, which is the segment reporting quality, which is at firm level. We want to merge these two dimensions of variables together to form our independent variable. So we have to convert our dimension part 2 segment level financial information to firm level information to be able to do this merge. So what we did is simply take the maximum of deviation of all reported business segments of the conglomerates to convert the convert the segment level variable to the firm level. Why we take the maximum standard deviation is because we want to, our goal here is to detect financial fraud, right? So we want to see, so we only want to focus on the reported business segments that that's most likely to be having problems, which is by our measure here having the most standard deviation from its industry peers. So this is the our variable construction. So I'm gonna skip this slide. So next I want to talk about our data sample and data processing. So our sample here, as I said, we collected the segment reporting of public companies in the US from CompuStat, and our time span is from 2000 to 2016. And our processing is very straightforward. So we dropped firm year observations without SIC code and CIK code, and we for the segment level industry identification, we use the 2-digit SIC code just to ensure that there is enough business segments within each SIC code. And for the missing value here is actually a big problem for us because, as I said, the first thing that we noticed from this CompuStat data on business segment reporting is that there are a lot of missing variables. And we want to make sure we deal with these missing variables in a very, very careful way, that we don't introduce extra biases or contaminate our data. So for missing variables, obviously the first option for us is to drop all of the missing variables, all of the reported business segments with missing variables for major financial raw financial data, which is not possible in our case because the missing data is just such a severe problem. So what we did here is actually, right, we first of all, in our dimension 1, as you can probably remember here, we actually took advantage of these missing data information and used this as one of the variables that we proxy for segment reporting quality. So the more missing raw financial information that the reported business segment has, the lower the reporting quality is in our case. And we also dealt with the missing data in a third way, which is we use the number. Oh, sorry, I actually just introduced this. So we use the number of missing values as the new indicator for our one of the variables in dimension 1. And also another way for us to deal with this missing value variable is that we actually used a machine learning algorithm, which is very good at dealing with learning from a data set that has a lot of missing values, and I'm going to talk about this in later slides. This is our whole kind of an overview of the data processing steps that I introduced earlier, but did not, have the more systematic. This is a more systematic overview of the whole process. So we would have the dimension 1 firm level segment reporting quality, dimension 2 the segment level raw financial information and financial ratios, and we convert the segment level financial information to firm level and concatenate the dimension 1 and dimension 2 as our independent variable, and then we concatenate with the AER, which is our dependent variable. Then we can do the statistical testing. So as I said here, because we have a lot of missing variables, so we also on top of the regular linear regression, etc., that we would normally do in a academic paper, we also want to introduce a new machine learning technique here that is very good at dealing with data set with missing variables, right? So this is called a balanced, this is called random forest classifier. So I'm very grateful that Kleber already introduced decision tree in his presentation, because I don't have to do that now. So a random forest classifier is basically, right, a collection of decision trees, and it would theoretically have a better performance than a single decision tree, and also would be better at dealing with missing data in a data set. So also on top of random forest classifier, we also added this notion of, well, we did not create this notion. We took advantage of this notion of balanced random forest classifier. So what it does here is because AER or financial fraud is such a rare case, so it's very imbalanced data set. We introduced the notion of balanced here so that this technique would oversample the AER or financial fraud cases to make the data set a little less imbalanced, and thus to improve the learning result. So here, finally, we get to the result part. Our base model here is the 2011 Dichol model, which is a very, very famous paper in the accounting literature. So they basically created the data set of AER. We did not collect the AER data ourselves. We used their data set. And their methodology of detecting AER is based on the firm level financial information, which is normally what academic literature use, right? The firm level financial information. So they use that to detect the financial fraud, and their accuracy is, as reported in their paper, is 61%. And I also listed the sensitivity, false positive and false negative rate here. And for our proposed method here, I also want to stress that our method only use the segment level information. We did not yet include any of the firm level financial information, although we do know that they are very important and can definitely improve our prediction results here. But for now, we only have the segment level information incorporated in our methodology, just to show that what's the comparison of the results from the base model, which is using the firm level financial information, and from our methodology, which is using the segment level information. And we actually see an improvement in the prediction results in our methodology, which is a 86%. It's actually quite an increase from our base the Dichol 2011 model. So this increase actually tells us that segment level information does have value, and it adds up to from our results here, it adds up to only looking at the firm level financial information. And for our model, for our result here, only using the logistic regression, although the AER prediction results are quite good, the false negative rate is quite high. So that's why we also incorporated machine learning algorithms here to kind of lower the false positive rate while maintaining the same high prediction AER prediction rate. So this is okay. This is the end of my presentation. Thank you for the time reminder. We have also have other plans, future research for other future research plan for our project. We also want to look at whether the segment level information has any correlation or causal inferences with the firm's earnings management, because apparently, like I said, a lot of firms would allocate the costs and expenses from their major business segments to very vaguely defined business segment like corporate or other. So we want to look at that relationship as well in our paper. And there are a couple other improvements that we need to make, but I'm happy to hear your feedback and answer any questions that you might have. Thank you.
So let's open the floor for some questions and comments. Oh, yeah, we have one question there.
Thank you very much for the analysis. Really interesting. In our case, our experience with the consolidated data, the groups, the information about the regions, when they provide the information, not by sector of activity, by the regions, what we have seen is that the decision about the region they divide the world could be different from one company to other. I mean, net turnover in Europe. In Europe, in some cases, they include the north of Africa, and in other cases not. It depends on the decision of the company, in the business decision. So the regions, although you find the regions have a different classification accordingly to the need of each company. In the analysis that you have done about if you find information about regions, for example, sector of activity or regions, the classification used is also, you take into account the classification that has been used and is the same in all the groups, or is something that you can't obtain from the data that you have used?
So if I understand correctly, you are more asking about the geographic segments.
Yeah. Yes.
So I want to first address that in our paper, we're looking at business segments. So it's divided by business operations. But in the US, they do, so it's based on the company's decision. Some companies would disclose their segments based on geography, right? They will. So when we go into CompuStat, we can actually choose if you want to look at business segments, which is obviously divided by business operations, or do you want to look at geographic segments? So we can choose that. But in our paper, we look at business segments. In terms of your question, so one example of like a company that discloses their segments based on geographic location is Apple. So they disclose their sales based on their sales in Africa, their sales in Asia area, and etc. So is your question about the
about the classification? In fact, it is the same if you refer to business. The analysis that you have done take into account the classification that is used by the companies, or only take into account that you have information about business sectors, or it is independent of the classification that is used afterwards, because depending on the classification, the information would be comparable or not.
Right. Okay. So first I want to say that the data from CompuStat is entirely extracted from the company reporting. So it's the business segments, whether it's business segments or geographic segments, they're all based on the company's reporting. We're not creating we're not saying, oh, Apple, you have this segment. We're not saying that. We're looking at the segments disclosed by the companies themselves and to see whether this information is valuable.
Okay.
Yeah. Thank you for the question.
Hi, hello. My question is a more technical one. Have you tried boosting algorithms like LightGBM, XGBoost, or CatBoost? Because this kind of algorithm works pretty well with this kind of.
Right. Like XGBoost. I'm pretty sure that this will improve our results. But from a academic literature point of view, our first thing we want to test here is that if we're using the same model as the prior literature, whether that will improve the results, because we're using different information, right? We're using segment information. Prior literature is using firm level financial information. So that's why we have the logistic regression. Yes, logistic regression here, because the prior literature, they only use the most basic regression analysis. So we'll definitely add more because we already showed that with the same model, we can improve the results. And we can definitely use like XGBoost to see if that further improves from the regression results. Thank you for the question.
Thank you.
No more questions? Okay, then